My name is Michael Guyad, publisher of the Lead Lag Report. Joining me for the hour is David Cox, who is a math geek and loves classical music, both of which activate both sides of the brain. So he'll add a lot of good things here to this conversation. David, for those who are not familiar with your background, introduce yourself. Who are you? How'd you get interested in markets? Where are you based out of? And what are you doing now?
Sure thing. So markets was just kind of the logical thing. People started taking the CFA designation back in university days, kind of 25 years ago. And so I signed up for that course and started to work institutionally. Kind of got a job in quantitative research with the math degree that I had, and kind of really became fascinated with markets. But that was really from an institutional standpoint. And I was just the guy kind of generating back office kind of quantitative models that did a lot in terms of optimizing global decision making, but then kind of migrated to the retail side, and I've been doing that for about 19 years. So I'm a portfolio manager in Canada. Kind of live in Waterloo area, and so I've just got kind of clients and manage a variety of discretionary portfolios where we are fiduciary on all those portfolios, segregated portfolios, and I just love markets, and really what kind of caught my attention probably most, what stands out is kind of the move to technicals. CFA designation, that's fine. I really don't find the CFA material to be very practical, just in the short term and in the management and actual decision making of markets. So it's the technical side and the CMT designation that I kind of found. And the reason I really found it was I will just never forget. Must have been I don't know, around 2005 or so, 2004. And I had, I was chasing a stock up and on behalf of clients, and we were all buying. And eventually I top ticked this thing. And oh my goodness, this stock must have cratered 45% against me. And I said, wow, surely there's a better way. There was a way to have known that this was about to happen. And that's what captivated me about understanding charts and how to read charts. And so again, CMT designation. And so everything we do is, I would describe it as fundamentally driven, but, fundamentally screened, but technically driven. So we make charts is what I do, and post, and that's what I like to do. And markets are always changing. Again, we can learn from them every single day, and we are all learning. There is no, this is the way it is. I just don't agree with that. Things can surprise us, right? So yeah, that's a little bit about where I'm at.
Okay, and you're in Ontario, so what type do you invest in? I assume you invest in U.S. markets too, but talk about sort of the mix of geographic locations that you invest in.
Yeah, absolutely. Great question. And, the Toronto market is very thin, very illiquid. And again, in terms of, it's almost laughable. You look at the Toronto mid-cap market, the volatility, or sorry, not the volatility, but the dollar volume is just, it's crazy low, crazy low. Like you look at, I haven't seen the numbers in a while. I kind of made them a couple of years ago, but the average dollar volume on a mid cap stock, it could be less than $10 million, 5 to 10 million, which is kind of crazy. Whereas you compare that to the stuff in New York, so we have no bias. Anything North American listed, we're involved with, but really because the trend has favored the U.S. markets over Toronto really since the '08 kind of highs. The reality is that we've had a predominantly U.S. focus because I'd rather go where the relative strength is. And so again, I don't really care. I'm kind of indifferent. But again, Toronto's a very weird market, right? It's not, as I said, it's not only thin, it's got liquidity issues, but it also has some very different sectoral exposures. And again, which is almost kind of laughable because a lot of the interlisted stocks that trade on both Toronto and New York are far more active in New York. So again, just always remember, we've got currency and that presents challenges for us too. We've had situations before where, you can sit there and be a Canadian investor in the U.S. market and suddenly have the Canadian dollar kind of move in a harsh way against us, and it offsets. It's part of the investing program, right? But the bottom line is right now and in recent years, we're predominantly, investing in securities that are trading in New York. Use definitely ETFs, but a lot of individual stocks and whatnot as well.
All right, so I'm a CFA charter holder myself, and while I'm not a chartered market technician, I have a lot of love for the CMT Association because I won the Dow Award twice for two papers that I put out. You use the term fiduciary, and that term is thrown around a lot in commercials and I think also on Twitter. I don't know if people really understand what a fiduciary is. Define what a fiduciary is for the audience, and of the two designations, CFA or CMT, which do you think lends itself more to being a fiduciary? Because I hear you and I agree with you that it's like even myself, right? I have people say to me, "You don't talk like a CFA charter holder," and I joke saying, I have to know my enemy, right? That's why I took
Yep.
the exams to begin with. But talk about that because there is a big difference in terms of being a steward of other people's money and how much conviction you might have in a particular trend.
Yeah, no, great question, and yeah, so I have to almost watch myself. I certainly have my view, and I have my beliefs, and occasionally I get involved on Twitter too, talking about CFA versus CMT, and right, and so again, I think from a fiduciary standpoint, when you have decision making responsibility, and you are essentially responsible to steward a client's assets, essentially as you would your own, to understand who they are, what they're trying to do, and how you're going to go and really professionally apply the tools of risk management and return seeking, balance those all out. I mean, it's a responsibility that I certainly take very seriously, and I think that the CFA designation is actually more the requirement almost to kind of get there. And so I think, in fairness, I think that is worth pointing out. So, like in Canada, it's a little bit different. The way, like, portfolio manager licensing in Canada used to require a CFA designation, and in my opinion, what they did, 15 plus years ago now, is kind of cheapen it. And what they did by doing is our local, Canadian Securities Institute, which offers an absolute ton of courses for licensing, went and created something else called the CIM, which is kind of an easier and much shorter, much less time consuming and energy consuming effort to get to the PM licensing. And portfolio manager licensing is certainly required to be, again, discretionarily responsible and to manage on a fiduciary basis. So, could you do that with a CMT designation? No, the answer is no, not in Canada at least. And but at the same time, underneath, I think the tools and again the way of learning and certainly understanding kind of how investments are structured and how there's a lot. There's a lot there. I mean, let's be honest. You and I both know, Michael, we've spent a lot of time, I'm sure, studying for the CFA designation. There's a ton of material there. But I think when it comes down to the practical aspect of my job, that is not what I lean on, or what I think I lean on anyway, as kind of the basis for how I'm going to go make decisions. But yeah, absolutely. From a fiduciary and an actual role perspective, it's very important because our industry, in Canada, which I know is quite like the US, certainly gives a lot more weight and a lot more credence to a CFA designation. Again, there's not going to be too many people that will even open the door with a CMT designation. But again, I would encourage that door to be opened, and I would encourage investors to realize that, again, we all are closet technicians. I mean, any person who has heard the US dollar is strong or inflation is going up, you're kind of referring to the chart. I mean, the chart exists. And so that to me is technicals. And let's talk about how to analyze that, right?
Yeah, it's funny. I understand the skepticism on FinTwit around CFA charter holders, right? It's almost like you're the enemy. You can't necessarily beat the market or do anything different than we can do. So, it's a waste of a designation. But at the same time, yeah, and again, it almost goes to that idea that I've used before. It's like, what do you call the person who graduated last from medical school? Still doctor, right? So I understand the skepticism, but I've always viewed the CFA charter more, and CMT as well, as proof that you are a hard worker, right? Because it takes a lot of effort to study for these exams, whether it's the CFA or the CMT.
Yeah, absolutely. No, I'm totally with you. I mean, I think the average CFA, I think they report, 300 hours per level, right? I mean, that's a serious commitment. That was before I had kids. I mean, I don't know how, you got to do it with a full-time job lockdown as well. So it's a major commitment, but it's also a huge door opener, and really a requirement in the industry. So again, would I look forward to doing it again right now? No, not at all. But again, thankfully, I'm not in that position. But I do get people regularly reach out to me looking for advice in terms of how to go and navigate their own careers. And so again, it really comes down to what you're trying to do. Are you trying to get an interview, or are you trying to manage money? And maybe those are related, maybe they're not, depending on what you're trying to do, right?
All right. Now you mentioned that you're managing separately managed accounts for retail, on the retail side. Take us through just a little bit of history as far as how you've navigated this year, what type of allocations you've kind of broadly made, with the caveat that there's probably distinctions among different clients, just to kind of set the stage for where we are today.
Yeah, absolutely. So, I mean, 2022 is going to go down as a huge historic year. I mean, it's not even done. But again,
you call it odd. You call it odd. I call it.
Well, yeah, fair enough. I mean, it's an unbelievable market. I mean, unbelievable that we're hitting history. I mean, the bond thing is obviously huge. I feel like for years I've been talking about the idea that this perception that bonds are low risk. I mean, it doesn't make any sense to me when yields were so ridiculously low. And for the record, they're still crazy low, I think. right? So the very fact that you've now say, we're it's kind of like, they've been manufacturing all this money, they've been keeping rates so, low for so long, and now finally, all right, it's time to kind of pay the piper and face the price. And the reality is that, you can't be surprised, or I don't think you should be surprised if you suddenly realize your bonds are tanking. Like, there was no compensation for these things, right? And this is the problem, is that this industry, as you know, kind of does things like, okay, the 60-40 is the way we go, and so forth. And I think that's, here we are. I think we're in the worst year for the 60-40 portfolio in 100 years. I just saw a chart on the weekend, and that's pretty bad. Certainly more than all of our lifetimes. So we run again, I hug several beliefs and my kind of key beliefs. So let me just kind of share them a little bit here. But I mean, the bottom line is, I think anything can happen. So yeah, that includes, bond prices falling more than they've, fallen in decades. That includes stock markets can go down fast. They can go all over the map. They could go up fast. They could be bottom. Anything is possible. I also believe that small losses are a whole lot better than big ones, which means, the only way you end up with big losses is you let small losses kind of grow. And that's a problem. So again, exits and managing risk is crucial. So in this kind of market, in this kind of year, I mean, the reality is, what you're trying to do is you're trying to live to fight another day, or in this case, almost another year, because it's obviously gone on, and it's harsh. Like, there's so many kind of twists and turns in a market. We all operate on different time frames. In fact, there's a bunch of chatter this morning just on my Twitter feed just about kind of time frame, because it's one thing to say that the market bottomed on Thursday, but again, I think some people want to go and say, oh wow, is that like, super, like a long-term bottoms? Like, I have no idea, but I wouldn't bet on it, because I don't need to bet on it. I just need to go and say, okay, fine, there's the level we can manage against, and so forth. So the portfolios we manage are very, very active, and we're very flexible. I don't stay convicted to anything, because you still got to manage risk. I typically would look at kind of a 6 to 8% loss as kind of like a worst case loss on a new position. So if something goes against us, I mean, whatever, you just got to deal with it and accept the consequences and move on. But in this kind of market, especially, like, let's say especially right now, because let's just talk about the last couple of months. Like, to me, the market was showing some pretty good signs, a lot of bull divergences and whatnot in kind of later June, and looking like that market had a chance there. And again, I was kind of all over it, and looking at it from an index perspective, looking at it from a technology and discretionary standpoint. But that entire rally, that, seemed like a decent rally. It looked like there was a chance that was something legitimate. It completely faded and more, right? I mean, we obviously made lower lows last week, which is significant. So how do you adapt? I mean, you have to be so flexible. And I think the most important thing, certainly as I considered in my role, is to regularly and every day, essentially, and every week, follow a routine where I see all the charts that I want to see that help me develop a market pulse. Because a market pulse, having some understanding of what I'm expecting and what, could come or not come, I think is absolutely crucial, right? If you approach the markets and just come at it today and say, great, this is up, this is down, you have no idea in what context you're operating. So I always want to know exactly what I'm thinking. What are the big risks out there? What are the what are the different asset classes really saying to us? What are the sectors saying? What are the underneath stocks saying? What's the market breadth saying? All these things have to be understood. So I have a pretty detailed process in the morning. I spend about an hour and 40 minutes from about 4:30 in the morning to about 6:30. I go through all my charts, get my sheets kind of ready, and that would be kind of buy lists and things that would be interesting to me if they did certain things, update stop spreadsheets and whatnot. And again, following that process is kind of, to me, is so important, because that is a pulse. How do you know what's going on? You don't just show up one day and expect to just get the markets. And in this year, there's no chance, right? You have to know what happened last week. You need to know what happened last month, last year, to understand what could happen, and be open-minded enough to see, where things could go, and manage accordingly.
All right, so there's a lot we can get into this. I love the direction that you're going with this. So first of all, on the point about time frames, I think is underappreciated on FinTwit, because you'll have people that are bullish or bearish, and they can all be right. It's just a function of where you stop and start your endpoint, right?
Yeah.
And what one time frame is. So I find oftentimes that the vitriol and sort of anger towards people that don't agree with one's viewpoint is more driven based on time view, right,
Yeah.
than anything else. But the other point about so, and I agree with you, and I've made this point many times. You're absolutely right. It should be no surprise that bonds would have negative returns, right? But you and I both know, as people in the industry, that people have been saying this for years. The surprise, and I can debate this from here tomorrow with people, but the surprise, at least from my vantage point, when it comes to treasuries, is the way that it played out, right? I always make this point that people talk in terms of endpoint, but they act in terms of path, right? The
Yeah.
way that you get to the endpoint. So we can all agree that yes, bonds were due to have a severe sell-off and spike in yields. But that's different than saying how it will play out, the interaction against stocks, in what sequence, in what number of weeks, things like that. And I've used these stats before. You look at the number of weeks that long duration treasury yields have risen, meaning treasury prices have dropped, using TLT as an example and the index behind it. Going back to 1961, you've never had any single year where on 73, I think 73% of the year, treasuries have lost money. So as a standalone, you've never had anything in history that shows this type of consecutive loss in the bond market, let alone the level of yields. That's number one. So that, I'd argue, is a surprise. And then the other surprise is that same stat also applies to the stock market. So if you look at the number of weeks that the S&P is down as a percentage of the year this year, it's second only to 1931. Everyone could have said, yes, stocks are going to go lower. But in this sequence, that to me is what is the bigger surprise. So I say all that from the context of when you're trading as a CMT and analyzing in an environment which has never happened before in history in terms of that sequence, what do you do?
Yeah, some great questions, and obviously a lot of conversation can come from this. I mean, you're absolutely right. So this is the thing. I mean, when you look at magnitudes, or magnitude of duration, or whatever we're talking about here, like time frame, right? So if bonds are getting absolutely crushed and there's no there's no bounce, right? That's information, right? That alone is information. In the same way that stocks that are down that should bounce and won't, I think that's information too. So these are all nuggets that we need to continue to go and accept here, right? And that's why I think that some people kind of try to oversimplify things, and I certainly see things all the time online. Where you post something like, oh, whatever, I'll say, oh, there's a bullish divergence on stocks, and someone will be like, well, that doesn't mean anything. It's like, well, it means whatever it means to you and me, and we're both different, and we operate on different time frames. But again, I completely agree. So this year is very unique. That's kind of I think fascinating from many perspectives. Like, we're a part of this, right? It's still happening. We're not done. We're not through this. But the reality is that when you look at how we got here in the bond market, you basically, like, bonds basically rose for like 4 decades. I mean, that's huge. Like, that's longer than a lot of people's lifetimes that are trading markets, I'll bet. So that's super unusual, right? We're living in a bizarre time where suddenly, everyone has become addicted to money and free money, what I mean, right? And the ability to never bother delaying consumption, to use rates that exist. And so suddenly we're having some backfiring of this, and now some questions, and now, inflation. But the problem is, look at current inflation rates, and you look at where the rates are, like the actual, yields and interest rates. It's like, it's a joke. Like, it looks like we got problems. It looks like they got to go a lot higher, to me. So if they have to go a lot higher, I don't know, bond prices could come down a whole lot more. I mean, maybe we haven't seen anything yet. And if we haven't seen anything yet, whoa, let's be open-minded to the idea that maybe this is going to cause even more calamity. Like, maybe this is only the very first kind of few innings. Like, again, I'm not necessarily saying that's my view here, but I'm open-minded. That's the whole thing about anything can happen. So yeah, brutal, like, third quarter in a row. Like, the markets are always presenting challenges. This year, they're presenting arguably new challenges. But I think that over the years, I've seen some pretty crazy things too, right? I mean, I don't know if you remember, like, the flash crash, markets falling 10% in 10 minutes. Like, that's...
Oh, yeah. And by the way, before the flash crash, the areas that were warning in advance, 2 hours, I always make this point, 2 hours before the flash crash, May 6, 2010, junk debt, if you look at HYG intraday, 2 hours before the Dow dropped over 1,000 points, HYG had like a 1987 style crash, meaning junk debt exploded. Credit spreads were just widening. And it's one of those classic gradual diffusion of information signals, right? Bonds moved first in a shocking way, and then stocks fell. But it wasn't really stocks that crashed. It was really bonds that crashed.
Absolutely. So these things are all, but they all give, and that's why you have to be looking at everything. So I would argue that right now, like, everyone needs to be watching yields. Like, I don't care if you're a bond investor or, a wannabe buyer of bonds or GICs or whatever you want. I think you have to know what's going on. So, like, last Wednesday, for example, I tweeted out that, hey, I don't know, like, we could have some massive turning point where we see, commodities and risk assets start to go up, and, US dollars and volatility and yields come back down. Like, I mean, and it could all happen at the same time, all in sympathy with one another, arguably, or all related or correlated, whatever you want to say. But it has huge implications for investment classes of all things. So, the reality is that I think there's always things that I want to see that aren't necessarily on my direct radar. So yeah, I want to be watching spreads, not because I'm sitting here trying to like monkey around in the bond market, because it gives us information, right? It's one more tool we can use. And why wouldn't we want more tools? Yeah, the flash crash. I mean, sorry, I already misspoke, because when I was actually referring to the August 15, in August 2015, in the summer there was a Monday morning that market fell 10% in 10 minutes. Like,
right, and actually I remember this, and I remember a lot of the Vanguard ETFs were trading at like a insane discount. Like it was like things that were, the market was open and maybe initially down 2-3%, and the Vanguard ETFs were down like 20 in the morning.
yeah, I mean, I was actually, it's kind of a funny story. I think I'll just use an opportunity to tell it, because I was sitting in a boat with my kids baiting hooks, okay, in the morning that opened, and I was on holiday that week. And again, the breadth had been so poor in the summer of 15 before that, the prior 2 months, like massive breadth deterioration, just like we had last year in 21, actually, massive deterioration. So all the portfolios that we managed actually were in cash. And I'm not even exaggerating. I ended up coming back to the office a week later and got client emails going, like, is there something wrong kind of online? Because it looks like we actually don't hold anything. It's like, no, we don't hold anything. But, again, we lucked out by not being there, but we were there and out of the market because the divergences were all over the place. The breadth deterioration was so serious and so forth. So those are the kinds of things that you can kind of go and add up to start to help you have a market view. Because I'll tell you, it's very, not useful, and it's certainly not productive financially or mentally to become super negative after super big weakness, in the same way that it's not productive or useful to become super bullish after a monster rise, which is why I love oscillators. I certainly want to use them. And I think sentiment is so important too. But yeah, the flash crash also was crazy. I remember when, those, like, there were stocks that were down 99%, right? It was crazy. And I remember picking up the phone, phoning my trading desk. I was like, I want to buy this, leisure and entertainment ETF. They're like, how much? I was like, I don't even know. Buy 1 million shares. And it didn't trade much. And I was so discouraged because I ended up buying a block. It was down, these were shares trading at $14 in the morning. By the time the flash crash happened, I was buying them at 22 to 23, 24 cents. And I acquired a small block of shares. It was all that was for sale. And then 2 weeks later, not even 3 days settlement, 2 weeks later, those trades were all canceled. I didn't get them because they were deemed that not to be fair. But like I put legitimate capital, mentally and financial capital, into making a decision. So I don't really agree with erasing trades, and it has happened, right? It's happening. It happened a little bit. Earlier this year, last year, right, Michael? In the commodity markets, we had some trades reversed.
Nickel, right?
Yeah, nickel. So I don't really agree with that. I often see technicians will say, oh, the price is always the price because it never gets reversed. Well, there's the odd example that something bizarre happens, right? But yeah, I mean, flash crash, who knows what's next? But here we are, crazy year. And I think we all need to be absolutely focused on all of the things that are happening, because the intermarket relationships are crucial. And I think what makes this year even more hard is that bonds and stocks are going down. Like, there really is no hiding place. You look at the sell-off in the utilities in the last couple of weeks, like, my goodness, like, that is major, right? Major. And again, no place to hide. So what do? Well, you got to navigate crazy carefully.
Yeah, no, and actually I'm glad you mentioned utilities, because I've been noting that the last couple of weeks, and that relates to the 2014 Dow Award paper from the CMT Association that basically documents that, usually when utilities are weak on a short-term basis, that tends to precede lower volatility regimes, which is what you want to see in a real risk-on environment. So utilities saw it, right? You can say in quotes, and they've also been strong pretty much the bulk of the year, which also in quotes saw the risk off. Now, I like this point about, we don't know what tomorrow brings. I keep going back to that point. It's all about the unknowable future. Everybody is basically providing an opinion when it comes to any trade, because nobody knows if it's going to work out except with hindsight. But you have to, at the end of the day, have some kind of historical causation to hang your hat on, right? So to develop a process that you can follow on a consistent basis. Now, let's play it out, because I think this is an important distinction. The unusualness of this year relates to the sequence and path of not just stocks and bonds, but in particular stocks and treasuries. Okay, sure. Part of that is the deflating of the duration bubble. I don't disagree. But I'm with you that you could see yields further rise in a major way. But I think if we're going to see that, in the intermediate term, let's call it, that probably would be, at least I hope, a more classic risk-off environment, meaning it's more driven by credit risk, right? So high yield would become where the pain is primarily felt, not the quote-unquote safe assets, which is supposed to be treasuries, except this year, which I've called my hell many times over. Play it out, though, David. Let's say that doesn't happen. Let's say you have a continuation of stocks and treasuries acting one and the same. I've joked that it's like these government bonds are acting like penny stocks. To me, forget about even intermarket analysis, CFA or CMT charters. To me, that's like an end of the world type of situation when you have so much leverage in the system, right? If safe collateral is acting this volatile, nothing is safe. In which case, that's why I keep going back to the end of the world is the bull case. That's like a system reset, right? How can you possibly have capitalism if the baseline of all of your capital, the risk-free rate, is acting riskier than everything else? So we'll talk about the intermarket side, but challenge me a little bit. Am I wrong in thinking that this is a binary bet? Because I've been making this case that the conditions are there for a melt up. Play it out. Are we in this kind of binary moment here where everything really kind of craters, or if it doesn't, that we have the exact opposite? Because I got to tell you, the sentiment that I see on FinTwit is so convinced. It reminds me very much of the March 2020 low.
Yeah. So again, I think this is why sentiment is so important. And I get uncomfortable every time you can see the boat is weighed toward one side, right? Because the reality is that, time frame matters, right? We already talked about this. So, there's all kinds of scenarios that could play out here. We could talk about the idea that suddenly you're going to have this kind of continuation, right? Which you pitched. But in the midst of, before that even happens, you could have a multi-month risk on massive melt up. You could absolutely have that, because I don't think that the governments, again, we've got a very indebted world, like huge. In fact, our country, I believe the last chart I saw, we're over 100%, debt, government debt, corporate debt, household debt to GDP. Those are big numbers. Everyone's got to pay more bills now with interest rates going up and whatnot, and yields. And so the reality is that I don't think that the central banks and the governments are going to allow for the collapse situation. I don't think so.
And they can't be that stupid to not know what's going on. We can rant from here tomorrow about the stupidity of monetary policies and fiscal, but they must be aware of this, right? And policymakers are very creative at preventing creative destruction. So if this is an environment which conceivably, if it continues, is worse than anything we've ever seen, because your starting point of leverage is so elevated, you can't make money on that bet.
No, and I think this is the problem, because first off, I don't even know whether you can give credit like you just tried to give credit. Because the reality, we've seen some comments out of some of these officials that clearly, again, the transitory and all these things apparently have not been seen, right, or not expected, right? When you look at the money supply growth, you're talking like 45 to 55%, like in a 2-year time frame. I think in both the U.S. and in Canada, like it's astronomically crazy. Right? You can't make this stuff up. So it has implications. So I think it comes down to confidence, because in reality, what are people buying and selling? They're doing it based on their convictions. And if everyone's conviction and everyone's faith in the entire system goes out the window, unfortunately, this is what happens. Selling comes in, right? And you have this environment. Who knows? Maybe it's like the flash crash where everyone just erases their bids, right? The computers stand back. Right, the automated stuff stands back. No one else knows what's going on. Everyone's super uncomfortable, and suddenly the market falls. And maybe it falls a whole lot. Like that's essentially what a crash is. But look at the UK, right? The UK. It's crazy what went on there. Literally weeks ago. Literally, right? You just had like bonds explode, or yields, I should say, explode from it looks like 2.2 to like 4.8 in like 6 weeks. That's unbelievable.
And that's the safe collateral that that's what people, that's why this is so cataclysmic and apocalyptic.
I'm with you. Like that's the thing. So we just saw, and so what happened? Okay, great. Well, they went and band-aided the solution and dropped their tax cuts and blah, blah, blah. But the reality is that, to me, what we just saw happen in that market shows what can happen in markets, and it shows how people are positioned, because somebody dumped those bonds to get those yields up there. And the reality is that causes new problems, because, as you know, there's leverage behind the system, and there's probably leverage that we don't even know about. We certainly know about some leverage. And the problem is it causes cascading problems. And that's the issue. And suddenly cascading problems cause confidence issues, everyone. And if you have, retail and corporate and institutional all kind of, having an issue, or we have a major pension crisis, yeah, there's a massive problem. I don't know if we can sit here and say and think that if the UK, literally almost appeared to collapse, like literally less than 2 weeks ago, I don't know whether we can think that it can't happen in our country. Like, I think that's like, kind of naive thinking.
And that's why I've been so, in my tweets, been alarmist and dire that if this continues, it's like an end of the world stuff. It will make Lehman Brothers look like a walk in the park. Yeah, having a private sector crisis is very different than a public sector crisis.
Absolutely. So, I think the logical thing, of course, is that the U.S. is not going to want to go and see it turn to that. So they're gonna turn the printers on again. They're gonna sort of stop the the unwinding of everything, and that works. That will probably work for a period of time. but to me, it's just kicking the can down the road, right? It's like what happened in '08. Like you had all these like institutions and pensions and all kinds of things that some of which shouldn't have been propped up. I mean, my opinion always is that come on, like companies need to stand on their own 2 feet, and if companies dig themselves holes and borrow too much and the rate environment changes and they weren't open minded to imagining the rate environment changing, someone's got to pay the price. And I don't think the taxpayer and the value of the currency is supposed to have to be the backstop. I think there is a price to be paid, and I think we don't normally see that happen. I think normally the governments are afraid to let calamity happen, even though it'd probably be more constructive for the longer term, right? If like, am I mistaken, or did I hear that 1,000 out of the Russell 3,000 companies are considered zombie by not being able to make their interest payments even today with rates up? Like I heard that.
I think the problem is, David, and I see this a lot, and maybe this is just a function of we're in the industry and we've studied this in depth, but people think bonds are no different than stocks in terms of the impact on day-to-day lives. I keep making that joke. It's like the same people that are screaming about how right they were about bonds and are rooting for bonds to keep collapsing. I have credit card debt. It affects them in a very real way beyond the value of your portfolio, right? So it is a very serious thing that's going on.
I think more serious probably than most people even realize. Because, to me, what's gone on here, we've created a big mess. And the real loser of this, I mean, isn't even the market participant, right? It's the, you got a low to middle class kind of environment here where you got people that can't afford to, kind of at the margin eat already. And now you got issues because prices are rising. And I mean, again, this concept of if there has to be a whole bunch of pivots and the US pivots the same way the UK did before this sort of situation allows itself to we got a bigger problem because, like, obviously that's going to cause more money into the system and it's going to cause more price rises and it's going to make the problem even bigger, which is going to, I mean, yeah, there's a negative case here that I can see it. Again, nobody's going to want it to happen. But again, you just have to point back to reality. When we've seen things that have happened in markets, we have to accept they can happen. I mean, the UK happened. It's happening, maybe, right? Like it's happening. The flash crash happened. Like it does happen. So I laugh because there's always people, especially online, right? You'll see these people that are like, oh, that could never happen. Like you can't take a big, $1 trillion company and it could go down 50%. It's like, of course you could. Like, why not? Like it's happened before. Like, of course it happened. So we have to be open-minded. And I think sometimes, your lens has to be a little more expanded than you perhaps are comfortable with. Because, yeah, there's some cases here that I've been concerned with in my mind for years that are suddenly kind of playing out. That's like, whoa, like this is serious. So again, managing risk, very, very important, very difficult. But wow, there's a lot that could happen. And at the same time, everyone's so negative in the short term. Like, let's be honest. I mean, the market should rally. I mean, it makes sense, right? We've seen such calamity, and it would make normal, perfect kind of historical sense to see a massive risk-on rally here. Who knows? Maybe starting right now. I thought it happened in the summer, and then maybe then we have to face the consequences like later on, like next year or 2 years or 5 years. Who knows, right?
No, and that's been sort of my mindset. And I'm doing it from a I'm vocalizing it, but everything I do is rules based. I made that point. Utilities collapsed. Lumber has been firming up. That's also typically what you see in advance of risk on. The sentiment is, I think, a big tell. I agree with you in that, and I saw this all throughout the last couple of weeks, despite me being adamant that the conditions are there. I got, instead of people saying, okay, maybe you have a point, I had a lot of people sending me vitriolic tweets basically saying, you're out of your mind, you're fucking stupid, look at your funds performance, whatever it is. And to me, it's like I've seen this before. When I used to write for MarketWatch, whenever I would make an argument for a big turn, that the conditions were there for one, the comments were always vitriolic, basically saying I was out of my mind. And I put that tweet out just before I slept last night. You're right when the counter argument is an insult. The counter argument is an insult because people are so entrenched in an existing viewpoint. They're overconfident about that existing viewpoint. They could still be right, by the way, but the payout is higher if you go where the pot is larger, where fewer other people are betting. That's the whole core of what contrarianism is about. So you alluded to it before. It's like bear markets have these multi-month massive runs where it looks like the bear market's over before it ultimately goes lower. Now, I'm very much of the mindset that this is probably a prolonged bear market because you have to still resolve housing. Okay, I don't think that a stock market bear market ends unless you have a housing bear market. I mean, you're in Canada. You tell me, right? That to me seems to be a logical argument and it's based on history. But in between now and then, yeah, you could shock people on the upside.
Absolutely. So again, I think we're back to the same kind of thing we're talking about, where again, we all get caught sometimes, kind of having biases, and your view can start to override common sense. It can start to override the actual reality, and I think this is a big problem, and it's a big kind of issue that a lot of investors face. Right? Of course, we're really talking about our emotion and pride and all these things because they get in the way. So, again, I can go and I see exactly what you're talking about. I'll make a comment. In fact, even just this morning, I did my Friday webinar, and to me Thursday, big reversal like that, and yeah, I think that's a bottom. But I have people that get upset, right? The people that are angry. It's like, well, that's impossible. Like we can't bottom because of this. And it's like, well, like whatever. Right? I don't know. Like 5% reversals are pretty large, and sentiment is so ridiculously negative that it wouldn't be unheard of at all. But I'm open minded, right? So if you get convicted to the fact that stocks always go up and every dip can be bought, or now stocks are always going down, and all these things have a lot more room to fall. I mean, just be I think you got to be open minded. I think otherwise, I think you're being actually foolish, and you're not a very wise investor, because again, information is actually dangerous to us as investors. And I think that when we think we know too many things, I don't know, like we can be caught by surprise, which is why I would never have conviction to the point that it would allow me to do something absolutely, stupid. So I'll give you an example, actually, Friday. Okay. So let's say that Thursday, I believe that the market bottomed, okay, which is my current view. Now, again, first off, let's just talk about time frame again. So what does that mean? Am I saying that, wow, we just made a massive bottom and we're going up to new highs? No, I'm not saying that at all. But it has to start somewhere. So let's just pretend, it's a short-term bottom, but we won't know it's an intermediate-term bottom until the short term is more legit, and then it becomes an intermediate-term bottom, and who knows? Maybe it turns into a long-term bottom. I, as an investor, know myself and know what my role is and how I tackle my job in managing money, and I'm not prepared to watch a short-term bottom pass by, to watch an intermediate-term bottom pass by, to suddenly have to feel like I got to go and buy stocks when they're 25% higher. That's just not how I operate. I'm not into that. So I would be more willing to say, fine, I'm going to go and stake some claims, do some buying, but I'm going to go and put my risk levels and whatnot, and I'm going to operate accordingly instead of going and trying to say, I'm stubborn. I'm not doing this. I know the market goes lower. I don't know that. And I see a lot of responses, in Twitter where people are like, they respond with exact levels of everything. I know the market's going to do this. I know it's going to do this. And it's like, no, you don't. Like, nobody knows. Like, nobody knows. The smart money, the dumb money, the big money, the small money, nobody actually knows, right? We can read and see through price and volume and whatnot what the market is doing, what participants are doing. But, when I just sorry, I'm digressing a little bit here, but I used to work for a pension fund manager. And, again, pensions are, to me, are called the smart money, right? Like they're making, let's say, buy side decisions where I worked. And the reality is that the problem is they're all humans, right? We're all humans, and everyone's got emotional wiring. And everyone is subject to getting this barrage of news and data, which can be frightening at times and which can affect your conviction, which can allow you to absolutely reverse course and allow you to become super duper negative, even if fundamentally, let's say, things are super duper cheap, which I'm not saying is the case right now. But here again, right, we've got our biases. We sometimes allow ourselves to be swayed one way or another, where we're not looking rationally anymore. I want to see a low. When I see divergences and I see oscillators are oversold and sentiment, like I'm looking for a low, like I'm looking for it. Reversal comes, boom, well, there it is. Now I operate, and who knows? Like maybe it ends this afternoon. Like I don't know, right? And I don't really care. I still have to manage accordingly. And anyway, I'm kind of rambling.
No, but that just to emphasize that point, nobody knows, including us. But the one thing that we do know is if everybody's betting on the same pot, the payout has to be less. That's what contrarianism is about. It's not about being counter to the popular narrative just for the sake of being, against the narrative. It's about where are more people positioning their sentiment in action. And if everybody, to your point, is on one side of the boat, the payout, they could still be right? But the payout is going to be higher betting on the other side of the boat. And it's ultimately about expected value, right? Probabilities times payout, right? Times the value. That I think is what's missed by a lot of people when they think about and get caught up in the echo chambers. And I've been the first one to say this environment's worse than 08 and worse than 2020. And I said that very early on, and I feel like finally people got it. And then people are saying, oh, now you're turning ultra bullish, right? Because now people finally got it.
Yeah, for sure. Which is hard for a lot of people to understand, right? Like it's like look at growth stocks. They've been absolutely ruined. I don't know what word you want to use, but whatever. They've been crushed, obliterated. So, if you're out there today and you're new, let's say you're new to the market, and you're approaching like, oh, growth stocks, they must go a lot lower, and you're going to go and stand up and start shorting growth stocks. Well, I don't know. Like, I mean, I think that's kind of crazy myself. I wouldn't do it. In the same way that I wouldn't go and look at, like let's say I don't even know right now, but let's say the Nasdaq or S&P. I think the S&P just sold off, I don't know, 22% or something since the August highs. So it's not in my thinking to go and try to like short a market that's down 22%. It's not where I'm at. I'm not going to do that. So whether I have some big picture view or thinking, it's not going to allow me to execute on that in that context, which means if it grinds lower and just drops another 50%, well, I'll have to stare and watch it and not be short because that's just the way it works. And that's the issue. But I know how I'm made up, and I know I can't feel comfortable, kind of getting involved after something is completely one-sided for too long. And yeah, it's dangerous. You can't look at something and just say everybody's bearish, so I'm going to be bullish today, or the opposite, because that's kind of foolish too, right? Like to me, I always want to know where the herd is, so I'm prepared to take the other side. But that does not mean I'm going to stand in front of some train the other way, because again, here's where we have to have a pulse and we have to have a view. Like I look at the 30-year Treasury market in the U.S. right now, and whatever. Let's say we're almost at 4, right? 4% is like crazy low against, I don't know, 8% inflation, or let's use 1980 calculations. I think it's 16 or 17. I think that's what the actual calculation would be if they didn't change the formula over and over again. So I think yields are so low relative to inflation. I don't know why they have to sort of suddenly collapse. I don't know why they have to collapse back down. I don't know, because I'm also guessing, if I kind of use my kind of thinking hat here, that there's probably some problems that are developing with this Treasury market. I'm guessing.
How can there not be? I keep using that line. It's like there's never just one cockroach in a hotel. I mean, what happened in the UK, to think that it's not happening in other places where just because you're not hearing about it is fantasy.
Well, I think that's the point. So when we can start to go and now apply that thinking, it's kind of like, okay, well, do I want to stand in front of this? No, I'm not really interested. Yeah, am I willing to maybe, not today, but if I see what I'm looking for, some actual buying emerge in treasuries, would I buy them for a trade? Yeah, maybe. But at the same time, again, it's doing so in the context of some of the issues we just talked about. I mean, the UK, I think, is a good one. Because could it come to here? Of course it could. Like, why couldn't it? Like maybe right now, as even as we're talking here, you got volatility coming down, you got, the DXY is coming off. Again, maybe this is the environment when, bonds could stage a bit of a rally. But you know what? The very fact that they're actually not right now is also, I think, interesting. And I think it's information. So all we can do is assess this information, right? The long bonds right now are up 0.5%. That is nothing in the context of what's going on. So,
right, but I do think, David, that the key there is you need to have stabilization, right? You have to cut off the tail risk of the systemic system reset that would happen if bonds keep on acting as volatile in the speed that it's been acting, right? So I would argue that as long as bonds are stable, in quotes, right, you're not having this kind of insane sequence that we've seen this year, that's enough to get animal spirits aggressively back into equities.
I absolutely agree. Yeah, because right now you've got a clear downtrend. So, again, as I'm sitting here going and let's say, again, I just made the comment, I think equities bottomed on Thursday. That's my view. But, what would I like to see happen? Yeah, I'd like to see bonds kind of rally here a bit. I'd like that, because I think the yield thing is a problem, because I do think there are issues behind the scenes here. And I think that we're facing the idea of something breaking, right? And we haven't seen kind of, I don't think, huge news yet. And there's got to be problems. I mean, the UK almost collapsed. We'll call that pretty big. But let's be honest. I mean, someone's been betting and leverage betting in the Treasury market. I don't know what's going on there, but surely something. At the same time, when I look at the chart, for example, of like HYG divided by TLT, so it's interesting, because I think that's back to what you made a point of before, Michael, is that we're not even seeing risk off there, right? Like that's an uptrend.
We haven't seen that risk. Thank you. I'm so glad to say, because I've been hammering that point too, which is why this has been such a frustrating period. Usually in risk off, you see high yield do worse than treasuries, duration adjusted. So I keep using that analogy, right? If you look at AGG, okay, the aggregate bond, AAA bond ETF, ex dividend, you're way below the COVID crash lows. You look at HYG, junk debt, ex dividend, you're still above the COVID crash lows. That is beyond ass backwards.
No, I agree. So this is why you wouldn't, if you were only looking at the Treasury market, you'd be thinking one thing about bonds. But this is why I think, again, this has important implications for us, because that should be actually dumping off. If people were actually completely scared off, I don't think the spreads in general are causing today's problem. I think they've come down, right, in the last few weeks. I don't think they're showing the same level of concern that equities and bonds showed into last week's low. So I don't know, but it's information. So how does it develop from here? Maybe the high yields start to tank as credit downgrades happen. I don't know. I don't know what credit downgrades even mean, but at some point maybe that comes under more relative pressure. But if there was really big issues, I'd kind of expect the high yield stuff to be kind of crumbling here. Now, other, just to maybe use another kind of proxy for something I like to look at, you look at like the preferred share market, which is, very liquid in my opinion, certainly is in Canada. And I'm sure it's much of the same in the US. But I mean, those things made lows, right? Like all the preferred share baskets that you can look at. So I think that's kind of, again, information about liquidity and whatnot. But again, we've got to be open-minded to the idea here that we could have reversals of fortunes in a lot of areas. And I think you're right, Michael. You don't need to have a bond rally to see a risk-on rally, but I think it would be nice to see, if we didn't have to kind of, it'd be nice to see some rally, but maybe it won't happen. I don't know, right? I don't know. Some of these things, I just don't have enough time in my day to think too hard about them. Again, I think price and volume, we can see what's going on. I was interested to see the whole meme thing. It's kind of certainly caused some laughing. I think it's funny when like let's just use the meme thing because I think it's legit, right? You have all this kind of, this concept of retail and options and maybe people doing things that institutions think are foolish. Like, who cares? I mean, people are able to do what they want in markets. And I hopefully we're all kind of adult enough that we can understand the risk we're taking. And I think if we're not, that's a problem. But, the reality is that all we can do is sort of go and try to be rational, right? Ourselves and know ourselves. Because if you don't know yourself, it's going to be a problem because you're going to look at what someone else is doing and try to think, overthink. So I don't know what it all means. Like, do I know that or think that crazy fast markets happen because computers are involved? I don't know. I guess so, right? Like, did I hear that the flash crash happened because the computers took the bids away? Yeah, I heard that. So I guess that's important. But what is a whole bunch of new traders coming in? I don't know what it means. Like, does it just mean a bunch of meme stocks go up and down like yo-yos and trade? Still technically, I don't know. Maybe that's all it means. And so I don't know if I care. I really don't. I think that price tells us what we need to know. Who's trading price? I don't know, because if there's more demand than supply, price will rise, and if there's more supply than demand, price will fall. And I don't really care who's trading it, although I am interested more from let's say, when you see institutional surveys, like, I love the Bank of America Merrill Lynch stuff. When you see the surveys there, the institutions are right now positioned as bearishly as they have been in decades. That's interesting for sure. I'd like to know that. But do I need to know that, a bunch of new traders are doing a bunch of dumb things with options in 2022? I don't know. I don't care. It doesn't really kind of fancy my, I just don't have any thought time for that. There were things that were definitely band-aided, right? There were sort of, again, I'll use Canada because I know it, but, you had pensions were underfunded and they were allowed, they were permitted to not make their contributions. And there were temporary measures, right? There were institutions that were permitted to not write down their value of their assets and all these things. And this is kind of like, the comic game that goes on behind the scenes that I don't think is necessarily constructive longer term. But there's a lot more debt now, like a lot, right? A lot more debt globally is riding everywhere and on everything. And now we've just had like already, a multi-year move up in yields because, so I don't know, like to me, again, when you got larger numbers, right, that are sort of having to pay, I think the burden is bigger and that means the trouble could be larger. And when you look at it as a global situation, this certainly is not some isolated, what's going on in North America situation. This is a very big problem. In fact, I could make a case that we got an even bigger problem because look at how the third world works and all the emerging market economies who all borrow in US dollars because that's what they're offered. Like that's a disaster in the making, right? That's a disaster. Like those countries are obviously never able to pay back their US dollar debts. And so I don't know, like you could have, are we going to see country defaults, corporate defaults? I mean, you normally would. I mean, in a cycle like this, Michael already pointed out housing, which I got a great chart, Michael. I'm going to send it to you after about Canada housing. But the point is, there's a lot of things here that can go wrong and or break, I think is the word, when we're looking at kind of the calamity right now. I don't know. Like to me, again, to the question, I think '08 was '08. Did things get learned? I don't know. I don't think so because, the reality is things were band-aided and now debt is so much larger. So could this be, the bigger game at play? I think it could be. I'm open-minded to the idea. But we'll have to see, right? I mean, but again, does that stop a market from turning crazy bullish for the next 12 months? No, absolutely not. But we'd have to be careful to still not forget all these things, right? So when debt becomes so large and these movements become so large, don't forget them because you don't want to be fooled into believing that, if everything starts going up again, that these problems are suddenly gone. We always want to be open-minded and learn and kind of tuck these things away because you never know when they'll be valuable to you. I think there's been a massive move, right? Because you've had massive marketing over the years, going like, you got to leave active. There's no opportunity. It's not worth the money, and so forth. But now, here we are in like 2022, which, as I said, the 60/40 kind of passive portfolio, I think, is having its worst year in 100 years. So that really starts to kind of put question marks behind those that have committed. And now I think the tide generally would start to turn, right? You're going to have the concept that, hang on a second here, maybe passive is not the way to go. So has it been a factor? I don't know. And are you right in saying that retail is not kind of concerned? I don't know. But as things go on, they become more important. They become more visible, right? So when clients get statements, they see what's going on. Clients start to sort of, the examples I've been giving, recently, things like the utilities, right? When you have like, big, broad, blue chip dividend, so-called blue chip dividend companies that are down 25% in 5-6 weeks, that is pretty big, very, very significant. And that hurts everybody, especially when you look at a portfolio. And it certainly hurts all the big investors too. So I don't know, but all I know is that the longer these things go on, the more they do tend to cause pain, right? Which is why at some point, if sentiment isn't negative, well, it gets more negative. And there's always room, arguably, at the margins, I suppose. Like there's always, like maybe when I'm unwilling to ever see a bottom or something, maybe that would be super negative or something. But to me, we need to all go with the flow and be open-minded, but understand that we can't understand everything. There's no chance. So you can surf all day long for articles about this or that, or this pension or this country. You're not going to find information that is going to be suitable. Markets price in information, and I think the best thing you and I and everyone here can do is continue to observe markets, see what the behavior is. Take what you think or what the textbook tell us should be the path, and look at reality, see how that kind of differs, and then start to go, okay, hang on a second. Like if stocks are supposed to be rallying, but they're not, or, these kinds of things, I think they're important. So again, tuck them away, learn. If things aren't going well, reduce your position size and keep managing risk, because you got to live to fight another day. What if 2022 becomes 23, becomes 24, and this goes on? I don't know, but we got to be open-minded at least, right?
Man, you depressed me. And as a way to end the conversation with that. That's all good. Again, this is a great conversation here with David. Any final thoughts, David, before we wrap up here?
No, I think this is, again, use these kinds of markets. These are like lifetime markets. They're generation. This is huge. Absolutely huge what's going on. Nobody has all the answers. So don't try to turn to the media, nobody has all the answers. I certainly don't. Michael doesn't. Like we know that, but be open-minded and kind of, again, try to be objective. When everyone's on one side, at least start looking at the other side. Again, I try to show some simple charts sometimes. When you have weekly, like let's say RSI oversold indices, like it's very difficult to want to become very negative after that much selling. So again, sometimes if things aren't going well, I always encourage you to think the other way. I was thinking about selling stocks here. Well, okay, try to take the buy case. Try to work it through. And I think journaling your thoughts is also extremely valuable. I'm not as prudent as I wish I was with it, but I think it's very valuable to know what you're thinking and why, and to kind of take some notes as an investor, because we're all learning. There is no professional, rookie, novice. Everybody's learning, and we all have to act like that. Otherwise, we're going to get blown over if something changes again, right?
100%. Very good, guys. Thank you, everybody, for joining. And David will be in touch. Thank you, everybody.
Yeah, my pleasure. Thanks.